One of your goals may be to retire at some point. The popular belief is to invest or put aside about 10% of what you earn to afford retirement at some point, whenever that is that you choose to retire. How much money do you want to make? Well, often the amount of money you make can be directly correlated with the amount of education you have. The popular theory used to be that in order to make so much money, you need a good education. So maybe you go off to college, certainly trade school, a combination of the two. Well, what is the value of a good education? Lots of question marks. That kind of depends. We know it costs something though. And then when you look at really these three things, which is investing in a house, buying a house, saving for retirement, obtaining a good education, what is left? Let's look at some data. So when we look at household income data, the average household income is about $89,000. The median income is $62,000. Looking at gender, women on average have a median income of $42,000 and men have a median income of $52,000. You may think, hey, there's some gender inequity there. Rightly so. If you look at householders between the ages of 45 to 54, this is the highest median income among all age ranges, and that's about $85,000. Now let's look at the differences in ethnicity. The median household income for Asians alone is about $115,000. For whites alone, it's about $90,000. For Hispanic and Latinos, it's about $68,000. And for Blacks, African Americans, it's about $60,000. So just from this data, you see that when you compare Asians to Blacks or African Americans, that Asians earn almost about 2 times that of Black and African Americans. Let's look at some more data. So the wealth and income gap. So here, I'm going to look at the difference between upper income, middle income, and lower income households, as well as the share held by middle income households relative to the others. So you look at the left right here, you see in 1970, low income households averaged $20,000. Middle income was at $58,000 and upper income was $126,000. In 2000, lower income increased from $20,000 to $28,000. Middle income increased from $58,000 to $81,000, almost $82,000. And upper income increased from $126,000 to $192,000. And then in 2018, almost 20 years later, 18 years later specifically, lower income barely increased from $28,200 to $28,700. Middle income increased slightly from about $82,000 to $86,000. And upper income increased from $192,000 to over $200,000 at $207,000. This graph on the right shows you the disparity. So here, looking at the trend line from 1970 to 2018, you see the share of US income, that lower income actually decreased from 10% to 9%. Upper income actually increased from 29% to almost half, 48%. But what's even more striking is that middle income went from almost 2/3 at 62% to under 50%. That's this yellow line here. So the income and wealth gap actually continues to increase. The rich continues to get richer. So let's go back to a few key considerations. One, we talked about retirement. Nearly 50% of all Americans do not expect to have enough money for retirement. So remember, the initial question is, why is financial literacy important? Another good point here is the average student loan debt has continued to rise for college students, but more so even for Black and African Americans. Remember, there was question marks related to the value of education. We know that education is valuable. The question is, to what point? Let's look at some more data, spending data and debt. So here focused on 4 types of debt. 1 credit card, 2 mortgage, 3 auto loan, and 4 student loan. The total owed by average US households is $7,000 for credit card debt, just shy of $200,000 or $190,000 for a mortgage, just shy of $28,000 for an auto loan, and almost $57,000 for student loans. In total dollars, that's almost $10 trillion in mortgage. Second is student loans at 1.6 trillion. Third is auto loans at 1.4 trillion, and credit cards at about 416 billion. The average household debt is $140,000. So why is debt important? Why is it important to understand how to manage debt and credit? Well, if you're going to own a house, if you're going to buy a car or go to college and have to take out student loans, this is pretty important because it shows you at least what the averages are. I like to use the perspective of like a financial life cycle. So there's 4 groups. There's adolescent, young adult, adult, and mature. When you're adolescent, you're pretty young. Maybe you do chores, you earn an allowance. You certainly want to learn a lot of good values, in particular habits about saving. Young adult, you're in high school and college. Here you're focused on why I would like to tab as atomic habits. Very small habits that certainly go a long way. You want to continue to nurture those habits. Maybe you get your first job, you learn how to start making some money, saving some, maybe saving for a particular purpose, to go to college or to buy some clothes or to buy a car or whatever it is. Third group is adult. Here you start managing multiple responsibilities, including possibly having a family, other obligations such as saving for your kids' education, retirement, healthcare, etc. At this point, you're balancing like maximizing the amount of earnings you have, but also you have to manage your debt. So if you're paying for education, you're setting aside funds for retirement, there's a reason to really understand your credit and how best to manage that. How to borrow smartly if you have to borrow at all. You want to increase your savings and maximize your investments to the degree possible. And then when you're in the mature phase, you tend to start focusing on how do you really kind of maintain your financial position and do a little bit of risk management. You may not be taking on as much risk, but you also may not have the same level of expenses. You may be maximizing your peak earning years at this point. So trying to prepare for retirement as best you can. These are all different stages that most folks, not everybody, but most folks kind of go through and kind of what they're focused in on during each particular cycle. So let's consider today's environment. Over the past decade, the average median income grew by more than 40%. However, the pandemic has created a challenge for many households because many either lost their jobs or they're earning less money than what they did before. Now, some US households are doing better in the midst of this pandemic, about 1 out of 7 families or households, or 14%. But nearly 3 times as many say that they're doing worse. And those who are doing worse are now having to lean on either utilizing their savings or incurring debt in order to meet everyday living expenses. One of the favorite sayings I have is money does not grow on trees. It's hard to acquire. So this notion of compounding is why I say it's better than sliced bread. So did you know that if you saved $1 or $100, whatever it is, 10% annual average return would double your money in 10 years without even doing anything else. If you can figure out a way how to get a 10% return for 10 years, your money will double. That's pretty impressive. Small yet good habits go a long way. When you do earn, when you do collect assets, you want to protect as best you can, either through insurance, monitoring your credit. One thing is you want to be able to focus on You're running a marathon, not necessarily a sprint. So how do you pace yourself? How do you build endurance? You're going to have to get your miles in. You have to do your training, maybe some level of cross training. It's going to be a journey. So running a marathon is 26.2 miles. It's a long way. So how do you enjoy the whole 26.2 miles? Well, you want to be able to train well, and you're going to see a lot of scenery. And there's going to be some ups and downs over those 26.2 miles. You want to be prepared as best you can. You also want to be able to discuss money. It's not taboo. So you could do that either in forming a group, maybe join an investment club, discuss with your family, also teaching your children, for those of you who have children. A key point of financial literacy is that's really creating a learning plan. You can start at any stage in life. It doesn't matter like what your age is. Now, you'll hear a lot of sayings of you certainly want to start the earlier the better, but there's no rule in terms of what's the age limit for you to start. There are many resources available, whether or not it's books, it's magazines, the internet, obviously, podcasts, numerous resources available so that you can learn how to be financially literate, manage your money, grow your money, invest, whatever it is that you're trying to do. You want to, I recommend identifying what you like and also what you don't like. Start simple and focus on what you like and build from there. You tend to actually spend more time on things you like than what you don't like. Learn how to grow and protect what you've worked hard for. So you certainly don't want to lose it too easily. And also consider consulting a professional. At some point, you may need an accountant for taxes, or perhaps you need some help in thinking about retirement, starting to plan for retirement. You can see a financial planner. A lot of folks think about starting a business, so you can consult an attorney. There's lots of great professionals and experts out there that have good information to share. Some recent trends. So consumers are more empowered than ever before. You have tools such as Robinhood, all type of vehicles for online investing and trading. There's no shortage of that today. There are a lot of complex financial products. There's complexity, whether or not it's loans for buying a home, even education. There are a number of investment options from stocks to bonds to cryptocurrency to real estate. Lots of great options. There's some folks that even focus on government aid. The question I have is like what to expect in the future. What's the level of government aid that really one can rely on? Maybe that's uncertain. Is that really even an investment option? My point here is that there's more choices than ever before. There's more complexity than ever before. So I like the method I call KISS, which is keep it simple. If you don't really understand it, if it becomes too complex, then perhaps you're not forced to necessarily invest in that particular option. Align it with your level of understanding, but as you become more aware, as you understand more, then your ability to actually invest in things that are more complex, maybe they give you a better return, better opportunity for return, that's the opportunity there. Also consider the financial environment. In 2008, not too long ago, just about 12 or 13 years ago, there was the great financial crisis. That was a pretty challenging time for everyone. And now we're in the midst of a pandemic. There's lots of economic challenges for way too many people. So the question I have is, what will be next? And how will you be prepared? There's lots of uncertainty going ahead. That's also part of the importance of trying to be financial literate, trying to prepare for that level of uncertainty. So if we revisit some of the key financial pillars, how much will you earn really is a question. How much will you spend? How much will you save and invest? How will you protect your money and your assets? And if you do need to borrow, how can you borrow and obtain the best terms? If you remember the data chart on spending on debt, The average cost for a house, the average debt or mortgage for a house was $190,000. The average student loan was $57,000. The average car loan was $28,000, just shy of $30,000. Odds are, if you're going to buy a house and a car and go to college, at some point you may have to consider, right, like taking out a loan. Some key takeaways. So have a good plan and know what to value. Just don't shoot in the air. Create a good learning plan. It's easier to learn when there's something that you have that you're interested in, as well as when you can team with others, family, friends, investment clubs, etc. Also try to develop what I call atomic habits. I call it atomic habits because just like an atom, sometimes it's the smallest seed that you plant that can provide the best return if you nurture it like a flower. Example could be like maybe just spend less than what you earn, or maybe save a certain amount each month. Figure out what works for you. In conclusion, again, money does not grow on trees. It's a limited resource and it's not easily acquired. The end goal is not a specific dollar amount. It should really relate to like how you want to live your life, how you want to enjoy your life. And financial literacy is more of a journey, not necessarily a destination. There are some other tips, such as continuing education. So there's lots of available resources today, from online learning, LinkedIn, certifications, inexpensive resources. Healthcare certainly can be very costly. It's more in focus today than ever before. The combination of physical fitness as well as diet is really important. I like to emphasize the last part though, which is protect your spirit. That concludes my presentation. Certainly open for questions, and it's been an honor to be able to present to everyone tonight.
How do I become as smart as you are?
Well, first you need the best big brother there is. When you get find that dude, oh man. If you have like great big brothers or big sisters, then you're golden.
Can you talk a little about LLCs?
What about LLCs? I mean, limited liability companies. So, they're broad in nature. They're a popular form of organizing a company, obviously for limited liability, but yeah, I mean, the focus more so is kind of on the formation and not necessarily the business itself. So are you interested in learning about the limited liability or about the specific company that you may have interest in?
I would say the limited liability for now.
Yeah, so I mean, and also the limited liability depends upon the nature of the company and business that you're in. The key here though is remember that it's exactly what it says, which is there's limited liability. Often that limited liability coincides with how you form the company. An example of that may be you may have partnership. If you have a partnership, you may have a partnership agreement, operating agreement, and those includes ways that you can limit the potential liability of how you operate. What's the liability for you and your partners? I mean, ultimately, I'm not going to pretend to be an attorney, which I am not. So, more specific questions about LLCs probably is more prudent to pose a question to an attorney. I've helped form LLCs. I'm part of an LLC, but by no means am I an expert on LLCs.
Is there a particular attorney that you have in mind for contacting about it?
I know of one or two that I certainly can recommend. So, if you contact Victoria, I can share who I know, but there's a broader group too that I may be able to help get you a list of key contacts as well.
Thank you.
Mm-hmm.
So we do have a hand raised. We have Keisha. Keisha, the floor is yours to ask your question.
Hi, unfortunately, I missed a little bit in the beginning, and I know a couple of the people that came on with me also missed the beginning snippets. If you could just kind of go back and go over what you said in the beginning so that we can kind of get caught up, as if we have any questions, we can kind of go back to those.
Sure, sure. And I won't bore you with the PowerPoints, but part of the beginning of the presentation relates to like the purpose of financial literacy really is like how to manage and grow your money. And then important themes here is like how to be well informed, ultimately to make like good financial decisions. And that should all be aligned with like what your goals and values are. So, it doesn't happen separate than of what you're really driving towards. And then once you start to identify really, what are your goals and values, then kind of mapping out a plan from there. And so I shared a few slides. I don't know if you had a chance to see some of the slides where I included some data. One was a slide that focused specifically on income, and it showed here's the median household income. It pointed out the disparity in income between genders. So women on average made less than men by about $10,000. I think the median income for women was $42,000, and men was $52,000. It also showed that for the age group between 45 to about 54, 55, that tends to be your peak earning years, and the average income for that was about 85,000. There was another aspect of that slide that showed the median income by ethnicity. And so Asian Americans or Asians, their median income was 115,000, and that trickled all the way down to Blacks or African Americans at about $60,000. So you were able to see the disparity in income, not only in gender, but also in ethnicity. Again, that's median income. I also show some data related to spending. And there I want to illustrate that, well, one, debt is a key component, right, for spending and for how we consume and meet a lot of our goals and values. So it showed the level of the average median income or medium debt for credit cards. The average household debt was $7,000 in credit cards. The average mortgage was about $190,000. The average car loan is about $28,000, and the average student loan is about $57,000. So if part of your goals and values are to eventually purchase a home and to eventually retire and possibly to maximize your earnings, and that may be way of getting the best education possible, which can be costly, then you may have to navigate how you go about borrowing, perhaps borrowing as smartly as possible, and how you manage that, monitoring your credit, trying to ensure you have assets, get the best terms possible, and how you manage that over time. So those are key themes, right? Like, debt is a reality for a lot of folks, but that doesn't mean that you can't incur debt in a smart way and be able to manage that to the best of your abilities. So that was another slide that I intended to illustrate and try to correlate with the message. And then also show the disparity of wealth and income between upper income households versus middle income and lower income households. And unfortunately, what we've seen is a trend in there becoming an increase in wealth gap. And so the middle income group back in 1970 used to represent about 2/3 of the share of aggregate income for all households. Today, it's less than 50%. And upper income households, which are households that earn over $200,000, they used to be just barely over 1/4%, less than 30% back in 1970 as a share of all income households. And today it's almost 50% of that. So those who are in that upper income category, they tend to make more, and there's a larger percentage of them. And the middle and lower income households now are getting squeezed more than ever before. So, the importance of everyone really becoming more financial literate is even more important than ever before. And then again, I don't know what part you came in on.
No. That's kind of caught us up. I
Okay.
did have another question in reference to, I'm kind of getting a little bit along the lines of this is kind of a preventative for things that are to come. So do you have any advice for those of us that have already incurred the debt and are trying to see what is the best way to minimize or alleviate the debt so that we can become homeowners and get the lower interest rates and just get an overall better credit score? Meaning, just say myself, for instance, I'm done with college, but on an average, you're saying that I think you gave a specific number. I know that I'm well over that number.
Yeah.
So what would your suggestions be for those of us that are well over that number and it's no way for us to go back and borrow responsibly?
Yeah. So it's that doesn't mean you can't manage it responsibly, right? So those are just median numbers. And there's always going to be folks who have more or less. One of the things that I like, there's this one book that talks about debt pay down. I'll try to get the name of it and share it with Victoria. But some of the strategies that are listed there is really like putting your debt in buckets, similar to what I showed in that slide. And so let's say, for example, you had 3 buckets, right? One is credit cards, one is mortgage, and one is your car note, or let's say even 4, including your student loans. And then maybe you look at one strategy is, look at where you have the lowest balances and maybe concentrate on paying those off first. Another strategy could be looking at where you have the highest interest rate and then first focus on reducing the debt where you have, so maximizing your payment where you have the highest interest rate and make the minimum payments on the other debt that's incurred. And so that's another strategy. That assumes that you have obviously enough money to certainly target one of those segments. If you do, then that would be a recommendation from a financial standpoint. I like targeting where you have the highest interest rate because that's your highest cost, and you're going to get you're going to get the best benefit the soonest from doing that. By focusing on where you have the lowest balance, you'll get the gratification of paying that off sooner than later, right? And so no strategy necessarily is right or wrong. It's more kind of personal preference. What you'll see though, and this gets into what I call the atomic habits, is once you develop the atomic habit and you're like, all right, great, I have these 4 buckets and I'm going to solely focus in on one relative to the 3, still manage the other 3, but really just, accelerate one of the 4, you'll soon find that you'll pay that off. That will, over time, improve your credit score. That's going to make more credit available to you. You're going to reduce your debt load. And then as soon as you pay that off, you're going to be able to then take the amount committed to that one segment and apply it to another segment of your choosing. And if you continue to do it, this is my theme of the marathon and not the sprint. So if you go, all right, long term, if you own a house, you're going to own the house most likely long term. Most folks are in a 30-year mortgage. So that's how I would look at it, which is I don't necessarily have to reduce my debt for my mortgage in a year. I have time to do that over a long term. And so, that's a long-term asset. And that makes sense. Education for most folks also is a long-term asset, especially with the cost today. And so that is those are some strategies that you can potentially consider. And again, there's numerous books out there about, methods for paying down debt or consolidating it or targeting one group versus the other. And I'm certainly willing to share, 1 or 2 resources that I found to be very helpful.
Thank you.
Mm-hmm.
So we do have a question following up with debt. They said the question is it better to settle collected debt or pay it in full?
Well, if you can pay the debt in full, without settlement, then the advantage of that is it won't be reflected on your credit score the same way. The benefit of settlement is that that may be a way to remedying, dissolving that debt sooner than later. So this gets back into like your plan and what your goals and values are. If you say, if I settle today, but if I have the intent of buying a house or I need to incur debt, soon after that, that may make it harder to do, or it may be more costly. So a question like that really depends upon what ultimately you're trying to achieve, not only in the debt reduction, but also in terms of, what are you trying to do in the next 5 or 7 years or whatever. But if you're not necessarily intending to buy a house, or you don't have to incur any other debt or take out a loan for anything major, then settlement certainly may end up saving you more money.
Thank you for that response. So now we have another question, or it's actually, they want a recommendation. They said, do you have a recommendation for online resources on how to determine a return on investment for your investments and savings?
So I don't know of like a generic site that will help that. It depends upon what your investments are. So the benefit here is like many banks offer that as part of their like online tools. So example, I bank with Chase. I may have, for example, some IRAs. Let's use the example that I purchased some stock and some mutual funds in that through the IRA account through Chase. Chase now has so many tools available that it literally can show you what is a 1-month return, 3-month return, annual return, and so forth. So if you're going through an existing bank, then that tends to be a little bit easier today than certainly what it was years in the past. If you're getting into other type of less liquid assets like real estate, that could be harder. That may not be necessarily a tool that you'll get directly from a bank. You may need to either hire a management company or get some software, or even just use Excel. If you're familiar and proficient with Excel, you can figure that out, yourself. So it really depends upon the investment and what you're trying to compute.
All right, Courtney, Avery, did that answer your question?
It did, Ms. Bradley, but I wanted to ask something additional to the last question, add to it and ask Mr. Bradley. Is it still when you settle debt, I know the law changed a couple of years ago where you will receive whatever that form is saying that this was income, and you have to file that on your taxes. So is that still the case? So don't think that you can just settle and there's no repercussions for it. They will charge it off sometimes as income.
Now that's a great question. I don't have an answer to that. That's the type of question that I would pose to my tax accountant. So one thing that I did wisen up years ago, although I did pass the CPA and have acted as an auditor, years ago I stopped doing taxes, and instead I hired a tax accountant, just because every year, as you can imagine, there was changes in tax law. But there's a lot of good folks, that do taxes. One is in my family, so not to put a pitch for Garrick, but some of you all may know Garrick. So Garrick is, a great guy at doing taxes. But there's a number of folks who do accounting for taxes, and I don't know the answer to that, but what you had shared kind of makes sense, which is when I think about how the IRS looks at things, and they would say basically you received a benefit. So you owe $10,000, you made a settlement, you wiped away the 10,000 by paying 6,000, and so you wiped away 4. They just wrote off the books. I wouldn't be surprised if the IRS considered that to be income for the purposes of taxes and charge you some tax for that. But I really don't know the answer to that. I would recommend consulting a tax accountant for that.
Thank you.
Mm-hmm.
All right.
Hey,
Tiara.
this is Garrick. Is anyone? Can you guys hear me?
Yes, we hear you.
We don't hear you.
I'm sorry, what was the question? I missed it.
What was the last question?
Yeah.
So the scenario is, what if someone were to settle on an amount they owe? So let's use the example. They owe $10,000. They settle the $10,000 liability by paying $6,000. So $4,000 is written off. What happens at that point with regard to reporting taxes?
Now, is this a settlement in regards to a legal settlement?
No, someone had asked about charging off credit or debt and from credit cards of probably student loans or something if it went to a collection agency. Is
Oh,
it
I see
better
what
to
you're
just
saying.
settle? Yeah.
So typically when you have a debt settlement, what it's called is a cancellation of debt. And typically what ends up happening of when you have a cancellation of debt is it actually increases your income. And so what ends up happening is at the point in time of when you have a cancellation of debt, that amount is essentially added to your income. And so really, and really with debt, there's only certain amount of tax benefit of really what you can get, and it really depends on the nature of the debt. As an example, if you have a mortgage, you can only write off the interest of the mortgage. The same as well as the student loan debt, except it's limited to $2,500. If you have a business loan, you could be able to write off the interest expense. But when it comes to credit cards, if it's non-business, if it's personal, you won't be able to write it off. But if it's business, you'll be able to write it off. But outside of that, the only benefit of it's really not a benefit at all, is if you get in a case of where you no longer have to pay the debt. Really what you're looking at is a question of, is it forgivable or is it not? Because if it's not forgivable, what you'll end up happening is it'll be considered a cancellation of debt, which that amount will be included in your income. Whereas it's forgivable, in that case, you don't even it's not a taxable event.
Thank you.
Yeah, no problem. Sorry, I was late.
Thank you for that valuable information. So now we do have another question. And the question that we have comes from Tiara, and it says, can you tell her the difference? Well, can you tell all of us the difference between a credit union and a bank?
That is an excellent question. I used to know the answer to it. So I can't answer that today other than, I mean, credit unions typically are smaller. I think the way that they're capitalized is different. The compliance requirements is more onerous for a bank than a credit union. I think the real question for either a member of the credit union or a bank, or for a borrower, is like how would that impact your financial decision? Will it really impact you depositing funds in either the bank or credit union, or having a checking account, or investing in any type of financial product? Today, I would say that there's not much difference between a bank and a credit union, with the exception of, obviously, with the big banks, you probably get more bang for your buck just because they're big. So their breadth and depth, the reach that they have, is certainly much more just because their balance sheets are bigger. So I mentioned like Chase Bank. So today, Chase Bank, you can kind of almost do any and everything. So, if you want to have a bank account, savings account, investment account, IRA, retirement accounts, you can bank online. They have numerous ATM machines, all over the world. If you want to do anything in foreign currency, you could get exotic in terms of investments. If you make enough money, you'll be part of their private wealth management. So there's really no shortage in terms of the products and the services you can receive from at least certain large banks, which may not be the case for many credit unions. Typically, you don't find credit unions to have that same level of girth as you would a bank. But for the standard, everyday, you have a banking account, checking account, savings account. You want to borrow some money to purchase a car or a house. Often you could do that same thing with a credit union as you can with a bank. And sometimes you can even get a better, some credit unions are mission oriented. So they may have capitalized in a way where they can give you better terms in some cases than what you may get from some banks.
Thank you for that answer. And now we have our final question, and it is it better to get retirement accounts with a bank or financial institution such as Mass Mutual?
Yeah, I'm uncertain there. A lot of you
Hang
have
on, I can chime in if you want me to on this one.
well, you can chime in really quick. I'm just let me just quickly say that it kind of depends. So wherever you get your retirement accounts, you certainly want to compare that to other alternatives. Remember, like one of the things I presented in the early slide, which is to be informed to make like good financial decisions. Part of that information is seeing what your options are. And so I don't know if there's a standard answer where you could say it's better to go with one versus the other. It may depend, but Garrick may have more or better information than I.
Yeah, I would say it really depends on the kind of investment and what you're trying to make. And what you want to compare is the features of what you get with each one of the platforms. And typically, when you're looking at the platforms, specifically for those that are specific for investments as compared to just going to a bank, the investment platforms are able to provide you more of the features and the support for you to be able to make the best decision when it comes to an investment. It's like, as an example, TD Ameritrade. When I go to TD Ameritrade, they have the investment articles. They have several different reports that's going to give their opinions, and their system is a lot more robust in offering several different options in regards to investing, options, futures, etc. Whereas in the case for a bank, depending on the bank of what you're looking at, they may not offer all of those features. But then in addition to that, not every investment investment provider is going to have everything housed all in one. Like, as an example, I'll take TD Ameritrade for an example. You could do stocks, you could do options, futures, mutual funds, etc. But when it comes to trading cryptocurrency, they don't have those features out yet. So what you have to do is then do your research on other platforms that will then offer what exactly you're looking for. So the first step is first understanding what investment that you want to make first. And then from there, taking a look at it and saying, okay, for the type of investment I want to make, what are the platforms that are then out there? And then compare the features of what information that they give you to be able to make a sound decision when it comes to your investment.
Thank you so much for that valuable information once again. And I do want to say thank you to my Uncle Mike, who was the first presenter. And I do want to thank my oldest brother for chiming in and giving his educational view on when it comes to financial literacy as well. And I also want to thank all of you guys that tuned in to the first event of this week, hoping and I am knowing that I'll see you for the rest of the events this week. And again, if you have any more questions, you can reach out to me or you can reach out to whoever gave you this information for this call, and we will direct you in the right direction. And thank you for tuning in to learn what financial literacy is all about. Have a wonderful night.